Oh, yeah.
All right, there we go. So look, good morning, everyone. My name is Patrick Downs, and I'm your host here this morning. The Masterclass is one of a series being produced by the Institute of Management Consultants here in Ireland, which is the internationally accredited body representing the profession here. And we'll be sending you a link to our details after the event. However, in the meantime, you can find us on imca.ie or on LinkedIn or Twitter. Now, look, I know it's not me that you're here to see this morning, so maybe a few housekeeping items before we kick off. I'm delighted to see we've got a lot of people listening in, and we're particularly delighted to see some of our colleagues from the UK also coming on board, and delighted to see our President John Byrne, who is here with us, and indeed we're in very good company as our international president is due to log in later, Dwight. And so to that end, can I just now ask you to ensure that you're muted? All right, thank you. So for information, as I said, we're recording this session from a GDPR point of view. If you have any issues with that, this would be the time to fold your tent and depart, because otherwise we will be sharing the recording afterwards. So from that end, this is the moment. And thank you if that's the case, and have a good day. Look, the recording will be sent out to you through the normal channels, and for those of you who have questions for Joe, it'll be an opportunity to have a chat with him, but please maybe put them into the chat box in the bottom of your screen. We will do our best to answer them during the course of the session at the end, probably mainly, and if we don't get to it, Joe will hopefully get back to you in due course. So as I said, look, conscious of your time, I want to take this out, and we're delighted to have Professor Joe O Mahoney joining us to share his knowledge and insights with us this morning. A lot of you know Joe, and he is passionate about helping the consultants across the profession, and he's there kind of, I suppose, as a bellwether of expertise in terms of the skill sets of growth in the consultancy profession. He is CEO of Consulting Mastered, which is a company that he has set up and established, and that's primarily involved in helping ambitious consultancies grow profits through evidence-based advice, Joe, I'm guessing. And he is also, for his sins, the professor of consulting at Cardiff University. And indeed, we've been fortunate to have had a colleague of his previously, Professor Simon Haslam, give us a masterclass just before Christmas. And that set the bar very high indeed for those to follow. So there's no pressure there, Joe. As most of you will know, and indeed no doubt read a lot of his work, Joe has published a lot of research in the consulting industry with many of the world's top business journals that you'd be familiar with, such as Oxford University Press. And I think he's got two books, with 2 or 3 books with Oxford University Press, and maybe Routledge as well. And maybe another one in the pipeline, no doubt, in due course, Joe.
Yeah.
And he's worked across the spectrum as a senior corporate consultant, and he brings a wealth of experience. He's been the head of an internal consultancy. He's been a solo consultant. He spent 15 years advising and coaching consultancies about growth, several who sold their firms. So he brings a wealth of practical and academic experience to bear this morning. And, Joe, I'm guessing you've engaged with a lot of the big firms, a lot of who will be clients of our own and members like McKinsey, IBM, Deloitte, Bain & Co, and all the respective big houses. And between students and executives, you must be north of 2,000 or 3,000 clients, if you want to call them that at this point. So, and you've also delivered projects that I'm aware of for, our collegiate institutes across the globe, including the UK division, the international division, our colleagues in the States, and the Institute of Consulting. And I'm delighted that you finally reached the summit in the profession with us here in Ireland, and that you've come out of the foothills of the Himalayas on this cold morning to achieve your lifelong ambition to talk to us here in Ireland. So with that in mind, it's a bitterly cold Thursday morning here in February, where unfortunately the promised cold snap won't kill off those bugs we would like it to. And we're slap bang in the middle of a global pandemic to boot, with lots of folks here this morning in lockdown. And we're all looking across the corporate landscape, Joe, and reflecting on the best way forward for our practices to thrive and survive. And we need agility and resilience to navigate a safe passage, as we were talking about earlier. And I seem to recall, I think it was Nelson Mandela was released from prison in South Africa after about 27 years on this day. And I guess, not being facetious, but we were all beginning to get a smidgen of the sense of the isolation he must have felt during those terrible years. But he came through, and he succeeded and went to the summit and led his country into a better place. And, another great bright light, Thomas Edison, was born way back in 1847 on this day. So look, with that in mind, Joe, I cede the floor to you to illuminate us over the next short while. So Joe, Akara, the floor is yours.
Thank you, Pat. Well, following Nelson Mandela and Edison, I I can only hope to disappoint. Okay, so right. So thank you first of all so much for having me on. I genuinely love every conversation we have, and both in terms of the knowledge you pass on and also the humor that you do it with. So so thank you for having me. So I'm going to be talking about some research I've been doing for the last 2 or 3 years. As Pat said, I have up until recently, my research was focused on large firms, and pretty much all consulting research is focused on large firms, because it's much more sexy on a research paper to say you're in with McKinsey or Bain or one of the others. However, over the years since I left consulting sort of full time, I'd had a lot of my friends who had bumped up against partner and then left come to me for advice about setting up their own firms, and I would tell them what I could, and I'd help out in ways that I could. But there wasn't much evidence-based work out there. So what I've been doing for the last few years is really researching growth. Specifically founders that set up a firm, grow it for typically up to 10 to 15 years and then sell, which people seem to think is quite rare, but it's not. There's about 300 of them a month that are sold across the world, mostly US and UK based, but Western Europe generally. So I'll be talking a bit about that research. So I've got some slides which I hope will be useful to you. I'm more than happy to answer any questions, or if you want me to go down a specific angle. I'm currently just finishing a book which will be out with Routledge in the summer. It will be 90,000 words long by the time I finish. So I'm not going to get everything in here. So I'm going to, rather than sort of just reel off a list of things that are important, I'm going to try and deep dive on a few things. So if you'd like me to go further on them, I'm more than happy to go into more depth.
That's great, Joe. Thank you.
So we're going to run through the background, the research, a brief bit on what buyers are looking for, and then the bulk of this will be about 7 capabilities that pretty much all of the firms that I researched had in terms of the successful ones. I like to say that every unhappy consultancy is unhappy in a unique way, and every happy consultancy is happy for the same reasons, and these are the 7 reasons that I've seen in my research. Okay, let's start with a bit of background. I'll go through these slides quite quickly so we can get on to the meat. Small and medium-sized consultancies, their market growth is 4 times that of large consultancies. This is surprising to a lot of people, but that has been consistent for quite a long time. I can go into the reasons for this, but in brief, large consultancy profit margins have declined over the last 20 years, which means they don't have the money for innovation or the time for innovation because the utilization rates have gone up to 90%. As a consequence of that, if clients are looking for innovation or new ideas or a bit more of a personalized approach, they're either going to McKinsey and paying $8,000 a day for junior MBAs, or they come to medium-sized consultancies, small or medium-sized consultancies. So that's why the market's growing, in my view. The 300 small to medium-sized consultancies sold each month. Another thing that a lot of people don't realize is that you don't have to be sort of up there in the 100 millions in order to be sold. Around a third of the firms are sold when they have less than £4 million. Excuse everything being in pounds here. I think the pound and the euro are probably pretty much equal now. So you can just convert it to euros if you want.
They're first cousins, Joe.
They are first cousins, and I hope they marry at some point again. But there we go. I'm from Cornwall, originally, and my father's family are from Cork, but certainly on the Cornish aspect, we know all about marrying cousins. On that inappropriate note, the two reasons why I started to go into this in a bit more detail. Firstly, there is virtually no evidence-based advice, and what irritates me a lot more is that there is a lot of bad advice out there. You might have seen it if you are a consultancy that is looking to grow and potentially sell or just grow. There's lots of sort of improbably young guys, typically in cheap suits, which promise you, to get to, 10 figures in 3 months and scale your business if only you buy their online course. I would urge you to avoid those. It's basically internet marketing, and it's not, it's not done particularly well in my view. So there's virtually no evidence on how small firms grow and sell. And so this is why I started the research project. The research specifically was, I interviewed, I did 75 interviews, 50 founders, in fact, 62 founders. Now, somebody's not on mute and I can hear their conversation, and I don't want to be prying into that. So do whack yourself on mute if you haven't already. Thank you. It's now up to 62 founders who grew their firms and sold them. 19 founders who didn't and were relatively unsuccessful, sadly. 6 buyers, and various other stakeholders in the consulting game. I guess on top of that, I've spent 25 years advising consultancies. I know I don't look old enough, but it's true. And I've trained over 2,500 consultants over the last 2,500 consultants over the last 15 years. So all of this kind of goes into the mix of the book. And some of what I'm saying, in fact, everything I'll be saying is based on quite detailed analysis. I had to code all the interviews. I've done a whole load of analysis using in vivo software. I won't bore you with the details, but I can if you want me to. Okay, what are buyers looking for? So this is from interviews with buyers of consulting firms. They're looking for solid, sustainable growth. They'd rather the growth was solid and sustainable, typically over 3 to 4 years, ideally 5 years, rather than dramatic in year 1 and year 2, and then 0 in year 3 and year 4. In terms of profits, typically 20% EBITDA, although we'll talk more about that later. Revenues anywhere between 1 to 40 million is the hot spot for sales. They're looking for a niche differentiated offering. If you think a lot of strategic buyers are looking for a specific gap that they want to fill. So they might want a, automotive engineering consultancy in Ireland, because they have the UK, Germany, France, and a few others, and they want a specific niche. Private equity buyers are slightly different in terms of they're less bothered about the niche and more bothered about the intellectual property and assets that are in the firm and the growth and profitability of those assets. Apologies if I talk fast, by the way, but this is being recorded, and I'm happy to go into things in more detail. This is kind of in order of importance. Different buyers emphasize different things, but this is loosely in order of importance. Fifthly, package popular intellectual property. We'll talk more about that later. Long-term distributed client base, ideally with no client contributing more than 20% of the revenues, and a strong management team. Roughly what buyers are looking for. Now, this gets skewed quite heavily by EBITDA. EBITDA isn't the most important thing to buyers. This is surprising to a lot of people. Growth is more important than EBITDA, but EBITDA is up there in the top 2. However, it does skew things quite heavily. So if almost for every 10% your EBITDA goes up, the price and multiple goes up by 1. And obviously, if you're bringing in a large amount of money, that can make a huge amount of difference. All of this is moderated. So this is quite high level, but all of this is moderated by a series of things. How fast are you growing? What niche you're in? How commodified your services are? What the economic cycle is like? And how well you brand and communicate what you do. That's quite important. Because a lot of buyers say they really don't understand the unique value proposition that consultancies offer. So once you've got one that you think you're happy with, then the job is to communicate it better. Okay, let's move on. Okay, so I'm going to highlight 7 capabilities, and in these I could talk about each one of these all day. So I'm going to go through them quite quickly, and I've only put the headlines in. And if you want more detail, do drop me a line. I'm easily available online, and you'll have my email at the beginning and end of this presentation. So 7 capabilities. Number 1, strategy, and these again are loosely in order of importance. Founders that are successful, and by successful they sell their firms. First of all, they sell them for a good multiple. Second of all, and thirdly, they do so without destroying their family and their mental health, which is an important point, because some of them sell successfully but personal life much less successful. And the book goes into that in some detail. So number 1, what's the vision and plan? Have you staked out your plan? And in terms of the plan, you know, what revenue are you looking at? What profits are you looking at? What does this mean in terms of clients, target clients? And what does this mean in terms of the number of employees or associates or contractors that you're using? And number 2, what is your unique value proposition and your niche? With each of these slides, I've put something that goes wrong, something that I see quite commonly. Number 1 is people choosing the wrong niche. We'll talk about this in a second. Number 2 is that people haven't done their research. So they think they're the only person in a specific niche, but they're not. Or they think that there's huge demand for their service that they've just created, but there isn't. They think clients will pay X, but they won't. And there's a huge amount of research. There's good, excuse me. There's a huge amount of research to show basically that the more research you do, the more likely you are to be successful. This shouldn't be surprising, but still many consultancies don't prioritize research into the market. So in terms of your unique value proposition, just in case people are unsure what that is, it's the overlap of what you're great at and what your clients value, i.e. will pay for, but different to what your competition is great at. Now, some people say that consultancies shouldn't be worried about competition. In fact, it's a good thing because it confirms that you're in the right market. I disagree with that. Most of the consultancies that did very well and grew very fast were those that had either low levels of competition, or if they were in a competitive market, they did things in a unique way and they communicated that uniqueness well. So that's the brand. We'll talk more about that later. In terms of the highest paying sectors and services, it kind of frustrates me.
Crazy, I don't have my earphones on.
It kind of frustrates me that there's a huge path dependency to a lot of what consultancies do. So, you know, they've focused on process management or HR in the public sector. And so they stick with that for 20 years instead of shifting it over a period of 5 years and ending up in a sector or service that is going to pay them much better. And that's obviously something that buyers are looking for. They're, you know, obviously, these sectors and these services, there are others. I could, you know, again, talk about this all day. There are others, but, you know, it is not that difficult to shift sectors. It's generally speaking, there are exceptions. It's slightly more difficult, but not impossible to shift services, especially if you're keen on learning, being creative, innovative, and developing new services. So please do so. Okay, so leadership. Okay, so the big thing with leadership, and I actually think this is probably most important, is the growth mindset. A lot of the less successful consultancies I spoke to, you know, it's quite sad in some ways because they were in an incredible niche. You know, I spoke to one firm that was in cybersecurity, digital cybersecurity consultancy in the 1980s. And they were still with sort of, you know, they had 7 people, you know, 30, 40 years later. And the guy wanted to grow, but they're really risk averse, didn't have that growth mindset, weren't constantly looking for new opportunities. The second thing in terms of leadership is having a focus on culture and values. This is particularly important, firstly, in terms of the client. And we all know that there's a lot of consistency between when clients will buy, especially relationship-based services, and the fit, the cultural fit with the firm. In terms of things that tend to go wrong, number 1, low appetite for risk. Now, I understand that, but the consulting market has grown year on year for the last, well, actually including last year. The most recent figures show that actually consultancy market overall didn't contract during COVID. It didn't grow, but it didn't contract as much as we thought it was going to do early on. So that's the first thing. And so my point being that there's good reasons to have a positive attitude towards risk, because the risk is generally quite low in the consulting market. The other thing that I've seen a lot of is the inability to delegate. So typically a founder will grow the firm, they do great work, it's their clients, they, senior partners, they hold on to their clients, they don't want anyone else to get them, and they don't want to delegate. Ideally, by the time you sell your firm, you as the founder should be irrelevant. If you want a low earnout period, which is the period of time that the buyer pays you to stay on, you can get that down to zero if you have in effect put yourself out of the job by creating good processes and good systems by which you can delegate sales, marketing, delivery, etc. to senior team or to the consultants, depending how big you are. So this is what this diagram is really saying, that over time, ideally, you want to shift away from the sort of founder's charismatic personal form of sales, and typically around the 20 to 30 employee mark, you need to get a lot more rule-based and procedural, simply because you can't keep all that information in your head. And a lot of people talked about this inflection point where you need to spend a little bit of time developing the company, the systems, the processes, the procedures, ideally getting in some form of professional service automation software like Avasa. Because you can't keep it all in your head, it can't be managed with 3 spreadsheets anymore. Some people choose to stay, smaller than that because they're uncomfortable with a larger, more formal firm. Okay, third thing, expertise. Now, the only sustainable way that you can put up your prices is to improve the value that you deliver. There's short-term things that you can do in terms of pricing techniques and in terms of what you're selling. But if you continuously improve the value of what you're selling, and that is really around capturing your expertise, looking for expertise outside the firm and bringing it in, whether that's training courses or whether it's partners or whatever. But also once you've got that, having an intellectual property system that captures and shares the knowledge well. And this gets increasingly important as you get beyond the sort of 20 employee mark, where it can't all be based on conversations. There needs to be some form of storage of expertise. And I'm just finishing the chapter on the book that talks about how to do that. In terms of what goes wrong, number one is quite low investment. As soon as the money starts to come in, they often spend it on, branding or a new website or getting that highly paid partner that's got connections all over the place. And very often there's minimal investment in sort of quality knowledge management, search systems, sort of making people accountable and responsible for knowledge in the firm. The other side of this is too high utilization, where junior employees don't have the time and space to update, improve, write the cases, lessons learned, improve the method that they were working on, or it hasn't been incentivized. I hope that makes sense. If it doesn't make sense, let me know. If you've got any questions, do please ask me. In terms of what buyers are looking for when it comes to intellectual property, now this should open some eyes or raise some eyebrows. Most people, when they talk about intellectual property, they think you're talking about the services or products that you're selling. And that's great. Revenue generating IP is especially useful, especially if it's digitized, especially if it's software based. Buyers love it. However, that's still not everything by a long shot. So proprietary tools and methods, methodologies. Have you created systems and processes by which underpin your delivery? Thought leadership. Writing good thought leadership is actually quite rare. A lot of people do it. But doing it in a systematic, intelligent way is something very different. Having it research-based, having a call to action, having it relevant to something that you do, rather than just writing posts because you're interested in them. And of course, people are going to read them. You'll get lots of likes and all the rest of it, but you might be confused as to why there's no sales being generated from that. So I can talk more about that later. And finally, unique databases, very powerful in terms of digital maturity indexes or any form of maturity indexes, benchmarking, any data that's this is quite interesting. A lot of smaller consultancies, they'll have done loads of projects, but they won't realize how much powerful data they've got that's of interest to the clients. Hello, Hillary. Okay, so number 4, services. Do you have a service development system? And this obviously, when you're a small firm, you haven't got the time or space to perhaps develop, highly formal services, though actually I've seen a lot of evidence to the contrary. And the productization of those. And by that, I mean, have you really thought about the customer journey? Have you branded it? Are you communicating it well in your thought leadership? So turning what you do, all that tacit knowledge that's in your head when you're growing the firm needs to come out of your head. It needs to be part of a process, procedure, and then really thinking about how you brand those services well. It's increasingly important in the internet age when clients are doing so much searching online, and the website is no longer just a repository of information about you. It's really your stall. It can be, we'll talk more about this when I cover marketing, but it can be done so much more strategically, so much more usefully. In terms of what goes wrong with services, low delivery IP. So this is something that buyers explicitly look for. These are your services and products. Making it important to everybody in the firm and giving people time and rewards for making improvements to your intellectual property is crucial as you get bigger, because again, you're increasing the value of what you do and you're increasing the communication of that value. And so clients will be happy to pay more, maybe not happy, but they will pay more. And low investment in systems. And, a lot of people that want to grow and sell their firm are very entrepreneurial. They love the conversations. They're perhaps more gregarious, more outgoing. They don't particularly want to be dedicated towards, changing their processes and procedures and systems. But that's how your performance increases. Your performance doesn't increase as you grow. The basis for your performance improvement isn't on, the founder's personality and, how great they are. It's on the systems, processes, and procedures that underpin the quality of your delivery and the quality of the firm generally. So investing in that and encouraging people to work on that is important. And having, leadership at the senior level for intellectual property is important. This is just something I do with some of my clients that I advise. These are consultancies that want to grow. And this is really talking around, thinking strategically about the services that you are delivering and the markets that you have entered. And so and you can do this in any way that suits your firm. But what I have here, I thought this would be useful to show. What I have here are things coded green for when they are high. So you code your services, green, amber, red for how profitable they are, their margin contribution. And then you have your markets in terms of growth. Okay, so that's roughly, so this is really based on research. And, the more research you do on new markets and the potential of new services, and that does mean talking to clients, the more likely you are to be successful there. That's my only point. Think strategically about this. Okay, marketing. So firstly, quality thought leadership. I've mentioned this already. Does your thought leadership have a call to action? Is it based on research? Is it based around something that you do or can do? And is it relatively new, or at least new to the market that you're talking to? And having some good visuals around that, infographics around that is quite powerful. So that's the first thing. Secondly, digital marketing architecture, and that sounds quite scary, but it needn't be. But if you have a link from your thought leadership to some form of email capture that links to your CRM, and then some form of newsletter that goes out occasionally, or at least a database of contacts that you can sell to. And tracking that and seeking to improve it. It's not particularly complicated. If I can do it, then anyone can do it. Now that becomes increasingly important as you grow. By the way, for people that have just joined, I'm talking primarily about there you go, Patrick. You cheeky beast. You muted me. So for the people that have just joined, I'm talking about just headlines under marketing. Under all of these things, I'm just talking about the headlines. I'm not talking about everything I could talk about because I haven't got that much time. In terms of things that go wrong with digital marketing, firstly, it's about the client, not about you, and more specifically about the client problems. So still on a lot of websites, I'll look at them and it's all about who they are, the credibility, the clients they've done in the past, how long they've been in business and all the rest of it. It shouldn't be about that, obviously. It should be about the client themselves, what challenges they're facing them. And if you can describe the client's challenges better than the client can do themselves, then you're onto a good thing. The other thing that I see a lot that is quite sad is that a lot of people dip their toe into digital marketing, and they in fact they don't dip their toe, they jump in. And they try and do everything. They do YouTube and they do LinkedIn and they do blog posts and they do a podcast, and they don't see much comeback on it in terms of, they don't see the immediate link to sales. Now, I'd say two things. One is that the effects of good digital marketing typically take a year to come through. In terms of building your brand, building your followers, and having an effect. And the second thing is that it's much better to do one thing really well, or two things really well, and they should be at different levels. You're trying to take clients from cold to warm and then from warm to hot, and different marketing processes will do that. And there's hundreds out there to choose from. But doing the ones that play to your strength and doing just a couple simply is so much better than trying to do everything. And you don't need to spend a fortune, although there is a correlation between spend on digital marketing and the growth of a firm, quite a strong correlation. So it's worth really thinking about that. That's something that I spend a lot of time with my clients thinking about is, what are you doing at the moment? What's working? What isn't working? And how can we simplify things? And very often that involves, getting an assistant or outsourcing some of the more mind-numbing work when it comes to marketing. Sales, it's interesting that founders very often, so the founders that I've interviewed that are successful, it's one of the big differences. Founders that have successfully sold their firms invest generally in sales training, very often start off doing it themselves, but then do it professionally. There's such a lot of research out there on sales training. So if you're seeking on to grow your firm and potentially sell it or have some form of exit in the future, buyers are looking at growth, and growth comes from strong sales, and strong sales, you're very unlikely to achieve it if you haven't had some formal sales training. And secondly, pricing sophistication. I won't talk about this too much because it's quite common, but a lot of people, still charge on the sort of daily rate, and that's fine for the consultancy in the short term. My view and the evidence shows is that it's not fine in the long term. A lot of the literature talks about value-based pricing, but obviously value-based pricing isn't suitable for a lot of projects. I'm a big fan of project-based pricing. I can talk more about that later if you would like. In terms of what goes wrong with sales, certainly when the firm gets larger, the founders or the partners very often think it's their responsibility. So I spend a lot of time talking to organizations that are growing about how you make sales the priority of everyone. It needs to be very clear to everyone in the organization that if that pipeline isn't constantly being filled, then their jobs are at risk. And that's quite a hard message, but it's a message that's necessary in order to make it central to the organization. And the second thing, really going back to the niche, is that if you're still in a sector that is, if you're still going through procurement, if you've chosen a niche that constantly goes through procurement, it's not impossible to grow and sell, but it's much harder to grow and sell. People. So this reflects back to what I was talking about earlier in terms of culture. Culture isn't just important for clients. Culture is important to attract and keep the right people. Obviously, as a small firm, you don't have the brand that McKinsey or Deloitte have. So it's harder for you to attract great people, but there are great people out there who want to join smaller firms. Why do they join smaller firms? Well, primarily it's to do with the culture and the values. And those really need to be worked on and developed and communicated in a quite a participatory way. So that's the first thing, is really paying attention to the culture. That will help you attract more people, and it will help those people stick with you longer. Secondly, in terms of sharing the love, now this is something that most founders have understood quite well, but you need to, buyers are looking for a minimum of 20% of equity shared amongst the senior management team, or at least certainly among the key individuals within that team. So, thinking strategically about how you share out the percentages and how you incentivize people and have that as a reward is very important. In terms of what goes wrong, no investment in the culture, or at least no thought about the culture, and poor leverage and delegation. And so I talked about delegation earlier, but that's also true of projects. If you are managing your projects badly, then you're going to have more highly paid people doing the work of junior people, or perhaps even worse, lowly paid people who don't have the skills having to step up and do the work of more senior people. So managing this strategically and properly is important. There's some great software out there in terms of professional service automation software. If you are seeking to grow, you should really be looking at that as early as possible. Happy to talk more about that at the end. And that's it. Hopefully that gives us time for some questions. This is my email. That's my phone number. I'm based in Wales. More than happy to chat through or give advice if you wish. So that's me done.
Joe, that was really good, and thank you, and apologies for that slight glitch. That's the joys of global IT. But in any event, I suppose really a powerful gallop through the presentation this morning, and a couple of points have been texted into me. And one of the things was that's come up is, could you maybe just flesh out the different types of exit?
Sure.
Just as one of them, and then following on from that was the other question that came in was the tension between, I suppose, the zeitgeist where we are at the moment, the tension between face-to-face and digital, and for people looking to, for example, exit and so on, we're in an unusual space. So how do you kind of bridge that gap where you're not physically meeting people? And then to the last point, maybe just to touch on the professional services software could be interesting to some of our members that are here this morning.
Okay, cool. Okay, thank you. So the first point was around, so the first point was around the forms of exit. So the most common form of exit is to be sold to a larger firm, and that firm doesn't need to necessarily be one that is the same as you. It doesn't even need to be management consultancy. A lot of consultancies, smaller consultancies, are sold to firms that want to move into a specific area. So they might be engineering consultancies that want to move into management consultancies. They might be HR consultancies that want to expand into change management or something like that. So the strategic buyers, i.e. those that want to fill a specific gap, are the most common. What has got a lot more common over the last 15 years is private equity buyers. And private equity very often has a bad reputation, and sometimes for good reason. But they've grown as investors in consulting firms simply because the cost of debt is so low at the moment. So, and the market's shown relatively consistent growth. It used to be that they were quite reluctant to invest because there were so few assets. Now that's obviously changed over the years. Private equity will focus slightly more on the financials, so they'll focus on EBITDA and growth, probably a bit more strongly than a strategic buyer. So those two between them account for, I'd say, 90% of all exits. There are obviously other ways. Other ways are simply seeking investment in as a minority share, so that some partners can exit. Another way is a management buyout. Now, very often you will get, in fact, typically you'll get a lower price if you go for the management buyout. But, a couple of the founders I spoke to preferred to do it that way because it kept the firm intact and kept the culture. And I can completely see that. All of these ways have different different methods of negotiating, and it's very much, up to you early on to start thinking about how you want to exit, not just in terms of, who's going to buy you? Because to be honest, actually, the things that you need for all of those different exits are pretty much the same. You need a solid, systematic organization that generates good growth and high revenues. But also in terms of, what do you want your earnout to be, and how bothered are you about keeping the company intact? I guess that's the first thing. In terms of the second thing, the second question was around this tension between digital versus face-to-face. Yeah. And this isn't something that my evidence speaks to directly, but in my opinion, there's the sales is still going to be very much face-to-face. I can still envisage partners jetting all around the world to do the sales side of things. But what I really would emphasize is the potential of digital to turn cold potential leads into warm leads. And I think this has been really underestimated by the consulting world. And I've seen a huge amount of evidence of high quality thought leadership, and a relatively simple but systematic digital architecture generating a vast amount of warm leads. And from then, obviously, you need to go on to the conversation, and have more face-to-face. And sometimes that can take place over Zoom. But obviously, if you've got a big client, once COVID's over, you're going to want to be jetting out to see them. Now, there was a third thing you mentioned.
Yeah, there was I suppose, and it goes to the heart of the question, where we get a lot of, I suppose, intellectual kind of thought process around this particular one. And it struck me when you were saying it may be kind of a way to harvest it. But a lot of the founders, if we want to call them that, people who set it and they're looking at exiting, they're getting to a certain age, but they realize that a huge amount of the intellectual capital of the organization is vested in their gray matter.
Yep.
Okay. And, from a point of view of a buyer coming in, how do they assure them that knowledge, that IP, if you want to call it that, is transferable? And it struck me when you're talking about the software element of it, maybe that's a segue for them to actually look at. But I mean, as a broader question, it is the perennial one that keeps coming up for the small, when I'm saying 1 to 10, and there's a CEO or managing partner who kind of is the lead, the rainmaker, if you will. And there's a huge amount of relationship management invested in that person. And the concern would be, how does that remain, or how does that value unlock and stay with the firm if that person leaves?
Yep. Okay. So thank you. That's a really good point. I sadly get a lot of founders, managing partners, who come to me and say, look, I'm coaching a couple of them at the moment, come to me and say, look, we're bringing in this amount of money, therefore we think our firm is worth X. What should we do? And then you look at how that money's being brought in, and you can tell that as soon as the founder leaves, 90% of that money's gone. So my message is typically the same, which is that if you go ahead, you're going to get someone who's in effect buying you and your contacts. And that's fine. But that means you're going to be getting a low multiple. So you're going to be getting a multiple of sort of, 2 or 3 EBITDA rather than, 7 to 13 EBITDA. So I in that position, I always say, look, if I was in your position, I would spend 2 years working really hard at systematizing your knowledge, creating processes, getting on board senior people that you can delegate to, so that number one, you get a higher EBITDA, but number two, your earnout period is a lot lower. So typically, if you are going in and, as the chief rainmaker, the founder, it's all in your head, you're going to be getting a 5-year earnout. And nobody wants that. That's a recipe for unhappiness, and probably low performance equals, low cash at the end of the deal. So I always, obviously, people on this call will be in the position where they're thinking, okay, I need to think about this earlier on. But with those people, I tend to suggest taking 2 years to focus on, systematizing the products, the services, and especially the sales process. And very often you get the reaction, which is, oh, no, that can't be done. You know, I've built these relationships up over years. My experience of people that have done it successfully is that those founders are overestimating their uniqueness compared to what can be done with the others. And it might be done in a different way, and it might be done in a more shallow way, but it can be done, and it means that they'll be getting a bigger pot of gold at the end of the rainbow.
Okay, well, that's the purpose of the exercise to a large extent. And so just to follow up, and I guess actually I'm delighted to see Dwight here, our global president of the Institute, and he's actually kind of also touched on that secondary question in terms of the reference to automation, which he says was intriguing, and it would be interesting to hear some more. And again, one of our colleagues, Phil, also asked, you know, the project-based forward a copy of, sorry, forgive me. There's a lot of questions coming in there. He was over the project-based pricing, if there was time just to touch on that.
Yeah, sure. Okay, so if you ask clients what they prefer fixed cost. If you ask consultants what they prefer time and materials. If you're doing time and materials, then you're alienating some of your potential clients. And certainly pricing innovation is something that clients prize, especially if you're going through procurement, actually, but they do prize it. It puts you at a strategic advantage. Now, there are ways to do this. So that doesn't mean that you have a fixed cost and that's it. It means that this takes skill in pricing, and it takes a few years to build this up. It means that you price accurately. And this is useful for negotiation, because then if the client says, well, you know, I want you to reduce your cost by 20%, you turn around and say, okay, well, what do we drop out? Rather than saying, you know, yes or no, and potentially losing the content. And then if there's follow-on work, then it puts you in a position where you can say, well, I'm going to charge for that because that's what we've agreed. You agree that early on, or I'm going to absorb that cost. I'm going to charge you for it, but I'm going to provide 100% discount so the client knows what discount they're getting. So there's a lot of, and I can, in fact, I do talk about this all day because I do a masterclass on pricing. And I'm more than happy if you contact me to send you. I've written a whole chapter on this, so I'm happy to send you the chapter. But
well, actually, Joe, as you're in a giving mode and a sharing mode, we may even ask you to come back and talk about that much loved subject to all of us, close and near and dear to our heart.
Yep. I'm more than happy to do that. And it places, and there's another reason to do project-based pricing, and that's that it encourages efficiency on the consultant's behalf. If you've got a consulting firm and you're charging, you know, time and materials, there's no emphasis on you. There's no requirement for you to improve your efficiency of delivery and lower your costs and improve your quality, because, you know, you're still getting that day rate no matter how long it takes. If you're doing a project-based pricing, then there's a real emphasis on improving your leverage, improving your project management, lowering your cost of delivery, so that you're making higher margin. And that's really where the value comes from. You obviously don't pass those cost savings on to the client, but your margin improves.
Yeah, no, that's to the heart of it. And the other question that Dwight kind of touched on was just in terms of the technology, that kind of software piece in terms of the professional services software.
Yeah. Okay. So professional
services software.
Okay. Good. So PSA is, so it didn't really exist 10 years ago. And it's really, really useful, and it's relatively cheap. So it does the whole, it's specifically targeted at professional service firms. It takes you along the whole life cycle of sort of the pipeline, but also in terms of the pipeline, what does that mean for your recruitment? What does it mean for your staffing? It incorporates, the billing and invoicing and all the rest of it. You can have different sign-offs. I've looked into it in some detail. My favorite at the moment for the growing firm is one called Avasa.
Okay.
I think if you, simply because their pricing is per user rather than one-off pricing, but there's a lot out there. I'm more than happy to send you, if you contact me, I'll send you the chapter on or the section on PSAs.
And Mark John he has asked, what advice would you give on measure growth for a startup, like managing growth from the start so you add value to customers without overstretching resources? Is this tied to working out your niche in the target market?
Okay. Hi, Mark. Nice to see you. I believe I know Mark from his days at Cardiff. So Mark, yeah, so I guess there's a stage in every startup where the quality of you want to really delight the client. So you do burn the midnight oil, you do the work, you do you do anything to get the testimonials and the cases, and that's great for the first few years. And that is the basis of your growth, because your client, that still clients, despite all the digital stuff, the biggest way they get consultants is through word of mouth and testimonials, and you need to manage testimonials strategically. So burning the midnight oil is something that all the founders, the successful founders I spoke to, they all do it for the first few years, but it is not the basis for success in the long term. Partly because you'll get divorced and you'll have a nervous breakdown, but also partly because buyers don't want a firm that is based on a utilization rate of 110%, because it's simply not sustainable, especially if it's the work of the founders, and they'll spot that. After a while, you need to become a more professional, systematized services that need to produce consistent quality results. And that may not be the same quality as you and your founder partner would have done originally, but it does mean that it's systematized and predictable, and relatively the assets in the firm and your processes rather than in you. So that shift always needs to take place, and it's something that a lot of people struggle with because they're worried about the quality going down or losing control of the firm.
Okay, so we have a few more questions, Joe, but I'm conscious that we made a promise that we would have a hard stop within the hour, and I'm conscious as well that people have other events to go to on the day that's in it. So what I'm going to do, if that's okay with you, is forward on those questions, sure, and perhaps we could go back to those people directly. Joe, look, I'm very touched that you gave us the time. That was a really powerful presentation, very knowledge deep and rich in terms of the content that you shared. So we're very appreciative of you giving us your valuable time. And on behalf of everyone here, thank you so much. We have a few events coming down the pipeline. As per normal, the masterclasses will continue. We have another one coming up, and we'll share those details with those that have registered. There seemed to be a little bit of a technical glitch this morning, as some of you may have seen. These speed wobbles along the digital highway occur from time to time, so I do apologize to the sensitivities of those that may have been intermittently offended. So I'm sorry about that. But nonetheless, parking that small glitch, thank you, Joe, and Gramila Mahagat, as we say in Irish. And on behalf of everyone, stay safe and keep well, and we look forward to having you back again. So folks, thank you, and on behalf of the Institute, thank you for your time, and we look forward to seeing and talking and meeting with you again. And in the meantime, stay safe, wear a mask and wash your hands. God bless, good luck, farewell, bye-bye.